So question 2, how big can this company get? And so I'm going to start off with this quote from current A16Z partner Catherine Boyle, because I think it transitions well from the past section of why is this founder the person to solve this problem into this new section of, well, now that we know that, how big can this company really get? And so she once said, quote, all of these companies are extremely capital intensive. Again, she's talking about deep tech, hard tech companies. And so being able to make the case that this is how things have been, but here's the paradigm shift that's happening and being at the forefront of that. That's almost table stakes for founders. We often say this about deep tech companies where there's a graveyard of companies with great technologists who spun out of universities where the technology was great, but they couldn't make the case, they couldn't tell the story, they couldn't raise enough capital to get through the valley of death. What we've seen with the founders who've been successful in these sectors is that they're just incredible at convincing people that this paradigm shift will happen. Some of these quotes finish on such a strong note. So again, I'm going to repeat that second half of the quote. The technology was great, but they couldn't make the case. They couldn't tell the story. They couldn't raise enough capital to get through the valley of death. And so that's a really tough reality for founders, especially again for founders of deep tech companies, that you can make this incredible technology, have these masterful blueprints and simulations and everything, but that might not be enough to get you to a major milestone, such as an IPO or large acquisition, because it's an incredibly capital intensive space just to get your product done. And it requires a lot of investment and lobbying with the government or whoever your large customers are, just to release and sell your first product. So, I can certainly believe in this person and I can give them money, but chances are if I'm an early stage investor, the capital I give the company won't be enough to get them to that major milestone. This isn't a company where they can take a seed and a Series A and run that all the way to the IPO. They're probably going to need to raise several large rounds of private capital. So I need a lot of other investors to see what I see. So the founder has to be this huge promoter of this technology and persuade others on their vision for the future. They have to exude confidence that their company will be huge because of how revolutionary their technology is and how desperately the world needs it. And that has to be apparent, or else these companies will fail. And so if you're listening and you're thinking, well, I'm not a deep tech company, I'm a consumer app, I don't need to evangelize a movement to grow to be a massive company. I'm comfortable raising a round or two and getting to a few $100 million in revenue and everything will be fine. But, and I didn't really think about this until hearing this quote. I thought the same thing as I just mentioned. But if you take that route of just few rounds coasting to a couple $100 million in revenue, if you can do that, great, obviously. But if you take that route, you run the risk of becoming a feature. And VCs don't invest in features because they often get swallowed by platforms. So current A16Z partner, Jeff Jordan, has a great quote on this, tells a great story. It's a little long, but really interesting. He once said, quote, I think the problem is that if you build an amazing innovation, the question is, do you control the distribution or not? So Comcast has that pipe in your house. The problem is if you build TiVo, which is an amazing world-changing thing, you have three outcomes that will eventually happen. Number one is Comcast says, you know what, we should buy you. You're an amazing company. But if Comcast goes and buys TiVo, then what about Time Warner Cable and DirecTV? They're going to say, hey, we're not going to sell TiVo anymore. It's owned by our competitor. So you have this weird case in M&A where you're going to have a controlled discount because TiVo is going to lose a huge chunk of their sales from the competitor. Option two is that Comcast says, hey, you know what? Let's partner because we're the ones that have all the pipes in your homes and we're going to take 99 cents of the dollar and you're going to take 1 cent of the dollar. And TiVo's like, well, that's not fair. I want a better deal than that. Comcast is like, yeah, well, screw you. We're just going to go with Replay TV. So you don't really have much leverage in that negotiation vis-a-vis the distributor. And then option three is basically Comcast says, that's a nice little tool you have there. We're just going to hire Accenture or a bunch of engineers to go build a crappy version of the same thing. And basically the problem is one of those three options always happens to TiVo. which is you build this amazing thing, it changes the world, but you don't control the distribution, and you either get copied or you get bought at an unfair price, or you get a partnership agreement, which is just really tilted out of your favor. So the lesson is, don't build TiVo, build Comcast. Because if you build Comcast and you have a good product and engineering team, or you can actually create stuff, you have unlimited option value to go roll out TiVo, to change more for TiVo, and so on and so forth. And so this goes on about what we said about features versus platforms. In this situation, Comcast is the platform. They have all the leverage. TiVo essentially inspired Comcast to build TiVo-like features for themselves. Comcast built on demand, and I only heard of TiVo because of an old 80s show I watched, and they mentioned TiVo. So Comcast had all the distribution and obviously wiped TiVo out completely. And so that's why you need to be big as a startup. VCs don't want to run the risk of a large incumbent just copying what you do if you don't have any leverage. It doesn't have to be physical advantages like Comcast had. It can be a social advantage like Instagram, providing a better photo sharing experience, adopting the friend group, and then securing distribution because, once a social network becomes, the gold standard of a friend group, it has a lot of staying power if it just continues to iterate and improve. That's a network effect like we talk so much about. And so that's why Chris Sacca's description of Instagram founder Kevin Systrom's pitch, as we talked about in the last episode with a16z, is so important. Systrom was adamant Instagram would get to 50 million users and had a plan on how they get there. And as an investor, I can back that. If they do get to 50 million users, then they have a platform now. And it'd be really hard for them to get disrupted. And so basically, I need to invest in companies that have the potential to be platforms. They have the potential to own that base in the consumer's mind. And then can go build off all those other features that they own on their platform because they control the distribution. Because that, if the company gets big enough to reach that platform level and becomes a multi-billion-dollar company, that gives me as an investor, as a high-risk investor, a margin of safety, which sounds almost like an oxymoron in venture capital investing. But current a16z partner, Alex Rampell, gives a good description actually of margin and safety in venture capital, which I had never really thought about before. But he said, quote, "You can try to apply a margin of safety to a wild, almost hyperbolic guess of if this thing really works, I'm going to invest in things that I think can fundamentally change the world. If they can fundamentally change the world in year 5, any price that I pay today is effectively undervaluing this company relative to where it is in year 5 or year 10. Otherwise, I wouldn't be buying this out of the money call option, but I'm getting a margin of safety, if you will, of I'm only investing in things that I think can change the world, that can be massive companies in year 5 or year 10, end quote. And so that quote gives some good perspective on what VC investing is if you're new to learning about this field. You're buying an incredibly out of the money speculative option in every early stage investment you make. You typically either lose your money on it, maybe get your money back if you're lucky. And if you're really lucky, one of those you can 100x or 1000x. There are very few in betweens. It's usually 0, 1, or 100. And so that's another reason why VCs only invest in world-changing companies because, in a $90 million portfolio with only 30 companies, if I invest $3 million into each, I need at least one 100x company in there so I can 3x my fund, assuming, all other 29 investments go to 0. But that 3x in a fund, that's only a decent fund performance. That's really not that good. You really want to be going for at least 5x. And so the chances of success in startups are so low that it doesn't really make sense for me to shoot for 10x outcomes, for me to shoot for great features. Because even though that sounds easier, to build a company for 500,000 users, paying $20 a year, that 10x company will likely get eaten up by an incumbent as just, again, a tiny feature, as the TiVo. Because, the platform company, the Comcast, can just add that platform, can just add that feature, a copy of that feature to their platform, already with all that distribution, probably charge a lesser amount of money for it. And then that feature company, eventually dies out, even if it was a good business. So I have to invest in 100x, 1000x, world-changing platform potential companies, because then I just need 1 in 30 of those to succeed, which is a lot more plausible for me as an investor. So essentially, I'd ask this question again of how big can this company get? Because I need the founder to just exude a world-changing vision for their company. I obviously want to see some evidence to support this claim, but like we talked about with the Kleiner Perkins episode, it can be insanely optimistic. I want someone who is going to go for it. They're going to go for that 100x, and they can exude that feeling of confidence in me and make me feel like, this person is the guy or girl to really solve this problem and become a platform. Because if I can feel that confidence in the founder, typically follow-on investors can feel that confidence too. And so that increases my chances of this company, raising enough capital to get to that platform status and becoming a really successful investment for me. So founders, dream big and pitch big, or else, investors very well might just write you off as another eventual swallowed up feature. So again, question number 2 is how big can this company get?